Yo, how's it going everyone? Welcome back to another video. In today's video, we're going to go over how I find my draw on liquidity. This is what I do every single morning to determine my bias for the day. You guys can also see me doing this in trade recaps. So to identify your draw on liquidity, I use the higher time frames, that being the daily, the 4-hour, the 1-hour, 30-minute, and 15-minute chart. This is where you can identify your possible DOLs. So let's first understand what a draw on liquidity is. So a draw on liquidity can be identified as external range liquidity or internal range liquidity, where price will tend to trend towards. So for external range liquidity, you want to look for swing highs and lows that are above the 15-minute chart. This will classify it as high time frame liquidity, and this is where the majority of sell or buy stops will be placed. Then you have session highs and lows. This will be London lows, London highs, Asia lows, Asia highs. You also want to identify low resistance liquidity leading up to your main DOL, and we'll go further and explain that later on in this video. For internal range liquidity, you want to identify unmitigated fair value gaps that are 15 minutes and above, and a bonus is marking out time-based liquidity, that being midnight, 18, 9:30, and the 9:30 wick. I also use volume imbalances to identify possible draws. On the right hand side, you can see that we have a proper checklist in order to identify the correct draws on liquidity going into every single day. So first, you want to identify the draw on liquidity based on the market maker buy or sell model framework. You want to be asking yourself, are we delivering from the buy side of the curve or buy side liquidity? Or are we delivering from the sell side of the curve or sell side liquidity? Second, you want to identify high resistance versus low resistance. Third, you want to see, are we disrespecting or respecting bullish or bearish fair value gaps? This is how you can set your high time frame scenarios. Fourth, we're going to go into premium and discount. And finally, how we can take a low time frame confirmation entry towards the possible DOLs that we have identified throughout the day. Starting off with number 1, identifying a draw on liquidity by using the market maker profile. You want to ask yourself, are we delivering from the buy side of the curve or buy side liquidity, or are we delivering from the sell side of the curve or sell side liquidity? You can see in the first example, we are in a market maker buy model where we generate buy side liquidity. Price will then sweep a high time frame low, which is sell side liquidity, where we will be given the opportunity to reverse in order to be on the buy side of the curve to take out that buy side liquidity. Then in the second example, you can see we're delivering from buy side liquidity, where we generate a market maker sell model in order to target the sell side liquidity below. So now moving on to the second step of the checklist, you want to identify where high resistance liquidity versus low resistance liquidity is being presented in these market maker frameworks. So you can see in the first example, we sweep sell side liquidity on the high time frame. You also want to identify, do we react out of a high time frame fair value gap, that being the 15-minute and above? And if so, you can then classify this as high resistance. Then, since we are in a market maker buy model profile, you can see to the left side of the curve if we have any low resistance liquidity built up. Onto the second example, in a market maker sell model, you want to identify us sweeping high time frame buy side liquidity, reacting out of a high time frame PD array, that being a 15-minute or above. Then you want to see if on the left side of the curve, do we have low resistance liquidity built upon that? Then you would be able to take an entry. For the buy side of the curve, you would take entries long. For the sell side of the curve, you want to be taking entries short. So now moving to a chart example, we're going to apply how to identify the DOL using market maker profiles as well as high resistance versus low resistance liquidity. You can see right now the market is trending towards these highs. We're inside of a high time frame market maker buy model, so you can assume that we're trending towards this buy side liquidity above. Now I want you guys to apply that high resistance versus low resistance. To identify this, you want to see, where did the market sweep liquidity? Well, you can see that we aggressively sweep the sell side liquidity on the 4-hour chart. Going onto the 1-hour chart, you can also see that we manipulate into a high time frame PD array right here. if we drag it all the way out, you can see that price aggressively wicks inside of it and we immediately reject above it. So in our high resistance criteria, you can see that we tap into a high time frame PD array, we sweep liquidity, and we immediately displace higher, which is what you want to see. Then looking at the left side of the curve, if I draw a vertical line, you can see that we have stacked trendline liquidity and failure swings in order for us to target. So going into the day and the daily profile, you can assume that we're in a market maker buy model and we're trending towards this buy side liquidity. So ideally going into the day, you want to be taking continuation longs. After we have identified our possible draw on liquidity, in this example, this is our buy side objective on the high time frame, and understanding that this is high resistance, if we just play out price, you can see that we do deliver to this buy side liquidity and taking out all the low resistance liquidity to the left side of the curve. Now that we've understood how to identify the draw on liquidity by using market maker profiles and high resistance versus low resistance liquidity, we now have to identify how to catch an entry or a continuation towards that correct draw on liquidity in order to catch a high probability trade. And this can be done by using the disrespect versus respecting framework and setting conditions for high time frame scenarios. So in the first example, you can see that we are still in a market maker buy model, assuming that we swept liquidity and reacted out of a high time frame PD array. We have low resistance liquidity built up. In this manipulation leg, you want to see us expand and displace higher and setting a high time frame condition, that being the 15-minute fair value gap or higher. When price retraces into this fair value gap, you want to set an if this then that scenario. So if we were to respect this 15-minute gap or above, we can expand higher and expect these draws above. Or if we disrespect and fail to displace higher outside of this fair value gap, we can then expect continuation lower. Moving on to the second example, you can see that we are in a market maker sell model and we displace and create a high time frame condition. Assuming that this is a high time frame fair value gap, we can then set an if this then that statement. If we react inside of this 15-minute fair value gap, we can then expect this low resistance liquidity to the sell side to be targeted and catching a trade where we take out that sell side liquidity. So using the disrespect versus respecting framework, let's jump onto a chart example and see how we can use this in the live market. So now moving to our next chart example, we're going to apply everything we learned as well as this disrespect versus respecting framework. So as you can see on the high time frame, we distribute lower and then we suddenly have an expansion move higher where we print out this aggressive wick. Well, what did this wick actually do? You can see that we sweep liquidity on the high time frame and also react out of this 1 hour unfilled fair value gap. So now you can assume that this is high resistance because we sweep liquidity and react out of a high time frame PD array, and we're continuing to disrespect bullish fair value gaps while respecting bearish fair value gaps. So you can see that we are still trending towards lower lows and we're in a market maker sell model. So understanding this and understanding that we want to continue to take out draws lower, we want to set a condition now of a disrespect versus respecting fair value gap. So going onto the 30-minute chart, you can see that we have an unfilled fair value gap right here that we can use as our if this then that scenario. So as you can see, price is also reacting out of this 30-minute fair value gap. So if we were to assume, if we were to trade inside of this 30-minute fair value gap and respect it, we can then continue that idea that this is high resistance and we will continue the trend lower towards this sell side liquidity to complete that market maker sell model. So if we play out price, you can see that we trade into this 30-minute fair value gap, but we respect the CE point right here of the midpoint of the gap. Now scaling down to the 5-minute time frame, you can see that we're trading away from this fair value gap. And if we mark out the low time frame imbalances, you can see that we're holding these bearish fair value gaps and sending price lower, right? Which is what you want to see if you want to continue that market maker sell model. And if we continue to play out price, you can see that we respect that scenario of that high time frame fair value gap of that 30-minute condition. Not only that, we target that low time frame, low resistance liquidity and continue the trend lower. So using the framework of that disrespect versus respecting fair value gap, we can then find an entry where we respect these bearish PD arrays and we continue to flush lower towards this low resistance liquidity. So now moving on to arguably the most important concept in trading, and that is understanding premium versus discount levels, because identifying the draw on liquidity isn't always going to be easy every single day, especially if we aren't given a low resistance versus high resistance scenario. Premium versus discount can be especially used when the range high and the range low are both high resistance. What do I mean by this, right? Well, if the range high and the range low both sweep liquidity and react out of a high time frame PD array, then you have to identify what premium versus discount is, and using what we learned from disrespecting versus respecting fair value gaps. So in a premium, what you want to see is for bearish fair value gaps to be held. In a discount, you want to see bullish fair value gaps to be held. So if we want to continue a market maker sell model and continue to target the range low, what you want to see is for us to complete this market maker sell model, for us to react out of this bearish premium fair value gap and respect it, as well as disrespect this bullish fair value gap in a discount where we can confirm that we will take the range low, and vice versa. If we were to continue bullish, what you want to see is for us to react out of this bullish fair value gap in a discount and then disrespect this bearish fair value gap in a premium to then take a trade where we target the range high. I also want to note that when you take an entry where you trade inside of equilibrium and then catch a reversal trade, this is the most high probable trade you can take because you're trading into the most optimal point where you should take your entry, that being equilibrium, and especially if we have low resistance built up on the opposite side. So now moving on to our next chart example, we're going to apply everything we have learned so far with premium versus discount levels. So as you can see on both sides of the market, we sweep out significant buy side and sell side liquidity while also reacting out of a 1 hour fair value gap. So you can assume now the range high and the range low are both high resistance and we're operating in HR versus HR conditions. So when we are in high resistant conditions, what you want to do is mark out the range low and the range high in order to identify what premium and discount levels are shown in the market and which gaps are being disrespected versus respected. So now going on to the 15-minute chart, we want to set our if this then that statements with knowing our premium and discount levels. You can see that we do have a 15-minute bearish fair value gap right here, and if I play out price further, we do generate a bullish fair value gap that we can use for our if this then that scenario. So if we were to remain bearish, what you want to see is for us to respect this premium bearish fair value gap, for us to disrespect this discounted bullish fair value gap to then confirm the range low. If we were to remain bullish, what you want to see is for us to react out of this discounted bullish fair value gap to then disrespect this bearish premium fair value gap to then confirm the range high. So these are the two scenarios that we can set with our premium versus discount conditions, and just playing out price, you can see that the price runs up. We respect this premium fair value gap but disrespect the bullish fair value gap. So seeing this, we can confirm that the market wants to go to the range low and we're actively being able to take out high resistance liquidity. So if we play out price, we eventually take out that low, but also going onto the 1 minute chart, you can see on the low time frame, we are respecting premium fair value gaps as well on the low time frame, while also generating low resistance liquidity to the sell side and the range low in order to confirm that trade. So now moving on to our final concept, we want to identify our low time frame confirmation entries, that being an inversion or a change in state of delivery, in order to catch a trade towards the identified draw on liquidity for the day. So looking at the left hand side, we are in a market maker buy model. You want to identify a bullish high time frame condition, that being a 15-minute fair value gap or above, you want to see us immediately displace out of this gap to then get our low time frame confirmation entry of an inversion, to then target the draw on liquidity above and taking a continuation trade. You can also notice that we have low resistance liquidity being built up towards this draw on liquidity. On the left hand side of the curve, you want to identify a bearish high time frame condition in a market maker sell model for us to displace out of it and getting a low time frame inversion to then target the low resistance liquidity that is being built up towards that draw on liquidity. Now going on to our final chart example, we're going to apply everything we have learned in order to catch an intraday trade towards that draw on liquidity. So looking at the daily chart, we have been expanding higher and then the market fails to distribute higher and we consolidate and get a deep retracement. In the current price leg, you can see that we expand higher and now we're given the opportunity of being in a high time frame market maker buy model where we are given the opportunity to take out all of these failure swing highs. In the current price action, you can also see we do have a volume imbalance that we can use in our trade. This is really strong because price tends to trend towards this volume imbalance. You can also see that we have a daily high. So these are the two draws on liquidity I want to see going into the day. Scaling down to the 30-minute chart in order to identify our if this then that statement, you can see that we do have a 30-minute fair value gap right here that price is currently reacting off of, and you can see that we do sweep liquidity in a high time frame. So you can assume that this low that was being put in is now currently high resistance. So now scaling down to the low time frame, we want to find our confirmation entry in order to take a trade towards our identified draw on liquidities above. You can see that this low is now high resistance because we sweep out sell side liquidity as well as reacting out of this 30-minute high time frame fair value gap. Looking for our low time frame confirmation, we do have a change in state of delivery as well as a 1-minute inversion right here. So taking this trade towards our identified draw on liquidities above, I'm extremely confident that this will play out based on what I know about disrespecting versus respecting, high resistance versus low resistance, and identifying our draw on liquidity above. So just playing out price, you can see that we do deliver and eventually take out that objective. And yeah, I hope you guys enjoyed watching this video. This covers completely how to find your draw on liquidity going into every single day. And yeah, if you guys haven't already or need help regarding trading questions, feel free to join my completely free Discord server. It will be linked at the bottom of the description. And I also go over my daily recaps as well as do weekly giveaways in there. So yeah, I appreciate you guys so much for the support. Like, comment, sub, and I'll see you guys in the next video.